Have you ever wondered what gives you the right to buy or sell something at a specific price without the obligation to actually do it? That's the power of options. In this episode, we're diving into the foundational concepts of options trading, exploring what makes them unique compared to stocks and futures, and understanding the mechanics that drive the entire options market. Many investors struggle to grasp options because they seem complex and risky. Unlike stocks, where you own shares outright, or futures, where you're obligated to buy or sell, options operate on a completely different principle. Understanding the definition, basic elements, and the distinction between calls and puts is essential before you can make informed trading decisions. Let's break it down. An option is a contract giving the buyer the right, but not the obligation, to buy or sell an underlying asset at a predetermined price, called the strike price, on or before a specific expiration date. Every option contract has key components: the underlying asset, the strike price, the expiration date, and the premium you pay. Call options give you the right to buy. Put options give you the right to sell. The buyer has rights, the seller has obligations. This fundamental distinction separates options from every other financial instrument. Start by reviewing the core definitions and elements we've covered. Practice identifying call and put options in real market scenarios, and then move forward to our next chapter, where we'll explore how options are priced using sophisticated models. Understanding these basics now will set the foundation for everything that follows. Now that you understand what options are, the real question becomes, how are they actually priced? In this chapter, we'll explore the sophisticated models and key variables that determine option value in real markets. Many traders struggle with option pricing because they don't understand what drives the price up or down. Is it just the stock price? Multiple factors influence option value simultaneously: the underlying asset price, the strike price, time to expiration, volatility, and interest rates. Without grasping these variables and how they interact, you'll find yourself confused by market prices. The Black-Scholes model provides the framework. This classical model shows how option prices decompose into intrinsic value and time value. Intrinsic value is straightforward. It's the immediate profit if exercised today. Time value reflects the probability that the option becomes more profitable before expiration. Implied volatility, the market's expectation of future price swings, directly impacts time value. Higher volatility increases option premiums because larger price moves become possible. Review the core pricing factors we've discussed today. Take real market examples and decompose their option prices into intrinsic and time value components. This hands-on practice will prepare you to apply these concepts when we dive deeper into advanced pricing strategies in our next chapter. Now that we've mastered option pricing fundamentals and time value decay, let's explore call options in depth. A call option grants you the right, but not the obligation, to purchase the underlying asset at a predetermined price, known as the strike price, on or before expiration. This instrument becomes valuable when you anticipate the asset's price will rise above your strike level. Many investors struggle to understand how call options actually profit or lose money as market prices fluctuate. Without visualizing the payoff curve, it's difficult to grasp when call buyers profit, when sellers face losses, and which real-world scenarios make calls the optimal trading strategy. This confusion often leads to suboptimal trade decisions. The payoff structure is straightforward. For call buyers, profit increases dollar for dollar above the strike price, while losses are capped at the premium paid. Call sellers receive the premium upfront, but face unlimited loss potential if prices surge. In practice, investors buy calls for bullish market outlooks, anticipating price increases, while they sell covered calls to generate income on existing positions, or naked calls for high-risk speculation. Understanding these dynamics clarifies when to deploy each strategy. Take a market example from your portfolio or a stock you're tracking. Calculate the break-even point for a call option by adding the strike price and premium paid. Then sketch the payoff diagram showing profit and loss zones. This exercise solidifies your grasp of call option mechanics and prepares you to evaluate real trading opportunities with confidence. Having mastered call options, we now turn to their counterpart, put options. A put option grants you the right, but not the obligation, to sell an underlying asset at a predetermined strike price before expiration. This fundamental instrument serves as a powerful hedge against declining markets and opens up entirely new trading strategies. Many investors struggle to understand when and why they would purchase or sell put options. Without grasping put option mechanics, you miss critical portfolio protection strategies and potential profit opportunities in bearish market conditions. The payoff dynamics differ significantly from calls, creating confusion about profit zones and loss exposure for both buyers and sellers. Put options allow you to profit from or protect against price declines. The buyer pays a premium for downside protection or speculation. The seller collects premium income but faces unlimited loss exposure. In practice, investors buy puts to hedge existing stock positions, protecting portfolios during market downturns. Sellers write puts to generate income or acquire stocks at lower prices. Understanding the payoff diagram, how profit and loss zones shift based on strike price, premium, and underlying asset price, clarifies these mechanics completely. Take a stock you hold and analyze how a protective put would ensure your position. Calculate the break-even prices for both put buyer and seller, then sketch the payoff diagram. This hands-on exercise solidifies put option mechanics and prepares you to deploy hedging strategies with confidence in your own portfolio. You now understand put options inside and out. But mastering options means understanding how calls and puts work together. In this final chapter, we'll compare these two fundamental instruments, explore how professional traders combine them into powerful strategies, and show you how options serve dual purposes, protecting your portfolio and amplifying your returns. Many investors treat calls and puts as separate tools, missing the strategic power of combining them. Without understanding their core differences, how calls profit from rising prices while puts profit from falling prices, how their risk profiles diverge, and when each applies, you cannot confidently deploy hedging strategies or construct combination plays like straddles and strangles that sophisticated traders use daily. Let's start with the core contrast. A call gives you the right to buy at a set price. A put gives you the right to sell at a set price. Calls rise in value when the stock climbs above the strike. Puts gain value when the stock falls below it. Their risk profiles are opposites. Now combine them strategically. A straddle, buying both a call and put at the same strike, profits from large moves in either direction. A strangle uses different strikes for lower cost. Beyond combinations, options serve two critical roles. Hedging protects your existing positions against downside risk, while speculation leverages small premiums into magnified returns on directional bets. Take two stocks from your portfolio and construct both a protective put strategy and a call spread combination. Map out the payoff diagrams, identify your break-even points, and calculate your maximum profit and loss. This hands-on comparison will transform abstract concepts into concrete trading tools you can deploy with confidence.